Hey everyone, I just want to give you a quick video about how to use ChatGPT to look up some potential investing options. So this is not financial advice, but I'm learning how to use ChatGPT the most effective way, so I thought I'd share this video. So one thing that everyone's talking about right now is the recession potential in the United States. So this has been going on for a few years now, but with tariffs, unemployment rate, and a few other factors, this is a potential option. So I thought, what's the best way I can enhance my portfolio to make sure I'm least likely to suffer from a recession? So I thought, let's use ChatGPT. This is a learning process, so if there's something you want to see differently, let me know. But I found this was very helpful. So we can start by saying the basic script of just saying, what are good stocks to buy during a recession in the United States. So we're just going to start by saying that first example, and then from there, what we're going to do is look at a couple different options. So they're talking about consumer staples, which is kind of what's expected, given the fact that you have Walmart, Coca-Cola, Pepsi are all pretty common stocks you want to buy during a recession because no matter what, people still go to Walmart. You still need food. People still love their Coca-Cola. People still love their Pepsi. You also see Colgate's on there for they do house care, so excuse me, healthcare. So they have the toothpaste, different things like that. Procter and Gamble, big with toiletries. So those are the top ones we want to talk about here as well. But I don't want to just go with the basic first answer they have. So we talked about what we're going to ask first, and then we also want to say like, okay, well, let's say in Procter Gamble, which is kind of what we expected, but we want to look at P ratios. So what of let's say we'll start with these. We have three here. So defense. Let's focus on specifically healthcare. I don't know how healthcare is Hershey's considered healthcare, but we'll call this non-discretionary. So of the non-discretionary spending, what companies have the lowest PE ratio? And for those of you who don't know that, lowest PE ratio, price is price to earning. So you want to lower price to earning because if your price to earning is lower, basically means you're earning more. The ratio is more than the stock you're actually earning. So if a low price to earning means that your earnings are higher than the price you're paying for the stock relative to other stocks in the industry. So if a high PE ratio is going to be like a growth firm like a Nvidia, whereas there's potential future earnings. So they're talking about non-discretionary. So Pfizer is trading at 14.8 PE. Merck says often in the mid-teens PE range. Johnson Johnson's higher, 20. So we're seeing here from this, it looks like Pfizer is, if this is actually correct, 14.8 seems to be the best option for the um, the best PE ratio for right now. And if we look down here, when we talk about consumer staples, which is like other non-discretionaries, Ultra Group, um, under 10 to 12. I wish they gave the actual number. I'm gonna say this is what you have to be careful about. Give the actual PE ratios for each company. Here we go. So this is where you have to be a little more specific. So healthcare stocks, Pfizer, Merck, Johnson Johnson. As you can see, Merck's actually a little bit better, which is interesting, but those are almost in the same boat. Ultra Group changes, but Ultra Group seems to have the best out of compared to Campbell and Conger brand. They have a negative PE. Okay, so that's what you want to be above zero, but you don't want a negative PE because that's basically saying the earnings are less than the actual price. Now, let's keep diving deeper. So we have some PE ratios. So let's start. Say we're looking at these three and these three. So we see the PE ratios for Ultra and Campbell Soup are pretty close. Same with Merrick and Pfizer. So let's focus on these four stocks. Next thing we're going to talk about too is any history of dividend cuts. So let's see. Do PFE, MRK, JMO, and CPB. And we'll just throw in. Have any history of dividend cuts? So what that means is dividend cuts is when the economy gets really bad. they actually, and their earnings are real bad, they will actually suspend dividends. So you can see Pfizer did cut in 2018, excuse me, 2008 financial crisis. Since then, it's not. Merck, no known dividends, the same period. Johnson Johnson, no known dividends. So see, this is another factor you have to consider is that, yeah, Pfizer may have some positive PE ratios. However, Merck and Johnson Johnson had never cut their dividend. If we're going for a dividend stock, it could be worth looking at that. Let's look here. Ultra Group, no different recent dividend cuts. Okay. Campbell, no recent dividends. Okay, that's great. And Congra, no. Okay. So we can look through here. PE, yes. Merrick, no, no, no. All right, so we're gonna cut these three. Let's focus on Merrick. Johnson, Johnson, and then MO, which was the what was MO? Ultra Group, and then Campbell Soup. Okay, so we have those. Now let's see what else. How is the debt ratio for, now we're boiling this down, Merrick, J&J, MO, and CBB. Put it into a chart. Now, another reason we want to talk about here is we want to have lower debt. So given the fact that you have in typical times of recessions, debt's obviously more of an issue. So the less debt a company has, the better. So you can see we're using the debt to equity ratio. So America's 0.8, so that means like 80% debt to equity ratio. So it's debt. The formula is debt over debt plus equity, and then typical Johnson Johnson low negative. Do the balance sheet accounting, total equity is negative, which makes this ratio negative. So it's debt to assets in this case. Okay, and then Campbell Soup highly leveraged to. So this is saying it's highly leveraged, meaning Campbell Soup has almost 2 times that of Merrick, which means they're highly leveraged, which is basically taking on a lot of debt. So I think Merrick and Johnson Johnson are the two I'm looking at. I don't like the high leverage. I don't like the accounting buyback they have. And let's use not a reliable measure instead use debt to assets. Okay. Yeah, more conservative balance sheets. That's what we want to talk about here. All right, so let's think of one more thing. And then the last thing I want to actually ask you is about the pricing power. So if I only have to pick Merck or Johnson & Johnson, let's see. What is the pricing power of MRK and J&J? Moderate. Okay. So Merck has some patent cliffs. That's what I'm worried about. Basically like saying Johnson & Johnson. Okay. So now we have Johnson Johnson Merrick, and then we can say, what is the dividend of Merrick, MRK, and J&J? So we see that right now I'm leaning towards J&J. I just want to see the final price of this. All right, so they have slightly lower dividend yields, annual dividends per share. So Merrick actually offers a higher rate here. So if we were looking for a recession, we could go with Merrick or Johnson & Johnson. If you want to take a little more risk, you would take Merrick because you're getting a little bit higher of a dividend, but we saw their pricing power is not as strong. And they also have some potential expiring patents. Johnson & Johnson is a little more conservative, but you're losing some of the yield. So I hope that helps a lot. I think if you want to look at this is just one example of it, but we can also look at what ChatGPT says for future examples, such as defense contractors and different stocks as well. So I hope you guys enjoyed this. I'll be doing some more videos like this as well. Thanks.